Well, for more on the state of oil, particularly after its best quarter in decades, we're joined now by Jeff Currie, Goldman Sachs Global Head of Commodities Research. Hey, Jeff, it's always great to catch up with you. Just to start off on the oil picture, where are we in supply and demand as we start the third quarter after oil had that big rebound in the second one?
Well, we'd argue you're in a slight deficit right now, which is an indication of the rally in prices and the tightness on the front end, the time spreads. However, from a trading perspective, we'd argue a little on the high side. You know, we're sticking with our $35 a barrel target on a near-term basis. I want to emphasize we're bullish further out into next year. However, remember, commodities are spot assets. They cannot price in expectations. And if prices go too high right now, it's going to disrupt this rebalancing process, particularly by potentially bringing on shale supply that has been shut in. But I think in terms of looking at the overall balance, you know, we'll look at demand. Since the COVID crisis began, we're now down to 10 million barrels per day, so that's a more than 50% recovery. I think, as you pointed out, you know, the gasoline markets were looking good and strong in terms of recovery. However, with the second wave hitting Texas and Florida, week-over-week gasoline demand in those two states was down 10% week-over-week. That's kind of concerning. Turning to the supply side, on OPEC plus. You know, there it's slightly a little bit more bullish than expected. You know, Libya really has yet to recover as many had expected. Now, on the shale, there the question really is, are we going to see a rebound in production that was shut in back in April and May? The high-frequency data would suggest that's the case, but we reserve judgment on that because particularly when you listen to what the companies are saying, they say they're going to bring some of that back online. I think that's really going to be the key that potentially drives this market lower.
Jeff, okay, you're basically saying that we are, in the United States, $5 ahead of fundamentals. Is that what you're telling me here? That is what the price at 40 is indicating versus your target of around 35? And what needs to happen to narrow that spread, do you think, to get us back in line with fundamentals?
Well, I think one of the factors that's driven the market off fundamentals is the weakness in the dollar and the sector rotation towards cyclicals. This is my fifth cycle in commodities, and the one thing that I have consistently underestimated over and over is that rotation. When you have strong emerging market demand growth and global growth as you come out of one of these crises, the weakness in the dollar puts a lot of upward pressure on commodities. You see it in the metals complex right now. However, metals, they have real strong fundamentals supporting them. Oil, on the flip side, it's being pushed above the fundamentals. So the one caveat I would say that's keeping the market at much stronger levels, I would argue, really is what's going on the macro basis, and that weakness in the dollar has really helped to support commodities.
Yeah, I'm glad you brought that up, Guy, and I did want to talk about copper because it does seem to be a discrepancy. Like yesterday, when we sort of saw, when we see a sell-off, copper is not really participating in that. It grinds higher here. We almost touched $6,100. Why? What's copper reacting to that, say, oil or other commodities isn't?
Well, for one, when you look at oil has 1 billion barrels of inventory that need to be drawn down from the crisis period. Copper inventories are very tight right now. One of the key reasons is that Chinese demand has been incredibly strong, driven by infrastructure investment as well as construction and heavy industry. Basically, while you didn't have a big stimulus program at the macro level from the PBOC or from the central government, what you did see is local government stimulating. And they did this by basically selling land to raise money to help shore up their finances, but also relaxing restrictions around purchasing of property. So this really kicked off a strong underlying construction and infrastructure market. Second factor that is making copper defy gravity is that Chile and some of the Latin American countries, they're experiencing relatively, a significant COVID problem, and as a result, they're having to shut mines. To give you some numbers, we went into this year thinking that copper was going to be a 400,000-ton surplus, and this was before COVID. What we've seen is that the demand is worth 500,000 tons and that the supply disruptions are worth 700, swung us all the way to a 300,000-ton deficit. That's substantial, and that's really what I'd argue is helping copper. One last point is the copper, as well as oil and the rest of these commodities, is being supported by a much weaker dollar.
Jeff, in 10 seconds, we're at 1,800 on gold, or just off it. That was your target, I understand. Do we go significantly higher from here?
2 weeks ago, we raised our target to 2,000. Driving that is strong investment demand for the developed markets. You see it across inflation-protected assets. And then you see a recovery in emerging market demand for jewelry. And I think the big one that's driving is tail risk inflation. There's a lot of focus on what inflation outlook could look like 2 to 3 years out.